Look, we need to talk. Not the finance Twitter version. Not the one punchy quote and a char version. A real conversation, the kind you'd have with someone you trust when real money is on the line. Because the most dangerous thing I'm seeing with a lot of NVIDIA holders isn't optimism. It's attachment. People start watching the ticker like it's keeping score. A green day feels like proof. A red day feels like an insult. And slowly, without noticing, the position turns into an identity. I get it. I've done that before. I own the stock too. But the market doesn't punish hope. It punishes laziness. It punishes people who stop updating their beliefs when the world changes. Here's the part that matters. The biggest risk to NVIDIA is not that AI disappears. It's not that the CEO forgets how to execute. It's not even that the next chip is bad. The real risk is that the biggest customers are quietly building leverage because they don't want to be trapped. Picture a meeting you'll never see on a keynote stage. A closed-door budget review inside a hyperscaler. CFO, head of infrastructure, procurement, the person responsible for power and data center capacity. A couple of engineers who actually have to make the hardware work at scale. Nobody is talking about the future of humanity. Nobody is impressed by a leather jacket. Nobody is sharing hype clips. The CFO is staring at a spreadsheet, and the question is simple. We're committing tens of billions again. Why does this compute line item keep growing faster than everything else? Compute is not a dream in that room. Compute is a cost center. Then someone says the thing everyone in that world already knows, but almost nobody says out loud. We're not only buying chips. We're buying priority. We're buying allocation. We're buying lead time. We're buying the right to stay competitive. That sentence changes the mood instantly. Because paying a premium is one thing. Being dependent is something else. This is why the NVIDIA tax idea landed. Not because it's a perfect phrase, but because it describes a real feeling in these companies. We're writing checks that are too large to be comfortable, and we don't have enough leverage. A CFO doesn't care how pretty your moat looks on a slide deck. They care whether they can negotiate. Now, when people hear exit plan, they imagine some dramatic moment where big tech wakes up one day and replaces NVIDIA everywhere. That is not how this actually happens. It's slower, more boring, more surgical. You don't start by replacing the hardest workloads. You start by replacing the workloads that are stable and predictable. The ones where you don't need maximum flexibility. Inference at scale. Ranking. Recommendation. Internal jobs where cost per query matters more than squeezing out the last 5% of performance. That's where custom silicon becomes a business decision, not an engineering hobby. And if you've worked anywhere near infrastructure, you know the real constraints aren't just raw speed. They're power, cooling, rack density, delivery schedules. What happens when lead times slip? There are teams inside these companies whose entire job is to say, we literally cannot plug more of this into the data center. Power is not infinite. Cooling is not infinite. Space is not infinite. So when someone says, let's scale GPU fleets aggressively, someone else asks, with what power? On what timeline? That is the moment where alternatives stop being theoretical. Now look at what the big players are doing. Google has been building TPUs for years. They don't need to defeat NVIDIA in every benchmark. They just need something that's good enough for their workloads at a better cost structure with more control over the roadmap. If a meaningful share of their training and inference runs internally, they spend less externally, they reduce supply risk, and they gain negotiating leverage. Even if they still buy NVIDIA for frontier workloads, the posture changes. Amazon is doing something similar, but with a cloud business mindset. AWS wants a menu, premium options for customers who need them, and cheaper in-house options for customers who care about price. The moment you can offer credible alternatives, you win deals you would have lost purely on cost. Meta has an even sharper incentive because of scale. Ranking and recommendation are core to their business. If they can cut cost per output there, that's billions. Microsoft is also investing heavily in internal silicon and rethinking parts of the stack. They're not doing this because they are bored. They're doing it because the bill is enormous and dependency is dangerous. Now, the bull argument you always hear is CUDA. And yes, CUDA is real. It's a huge advantage. It has been a big part of why NVIDIA became the default. But here's the point people tend to dodge. The industry is actively working to make CUDA matter less. Not because developers hate NVIDIA, because buyers hate lock-in. When you're a hyperscaler, the dream is flexibility. You want to be able to shift workloads across accelerators based on cost, availability, power constraints, and deployment speed. That requires layers of tooling that don't break every time you change what's under the hood. So you see more focus on frameworks, compilers, and abstraction. Not perfect portability overnight, just better portability year after year. And pay attention to who benefits from that. The buyers. They fund the tooling. They hire the talent. They sponsor the projects. They shape the ecosystem. That alone tells you where the incentives are pointing. None of this means NVIDIA is finished. That narrative is lazy. NVIDIA will likely remain the best answer for many frontier workloads for a while, especially when time to train and operational maturity matter. The real story is simpler and more important for investors. Pricing power won't be automatic forever. It becomes contested. It gets negotiated. Hard. And that's what eventually shows up in the stock, because markets pay a premium for permanence. When permanence turns into competition, multiples change. History helps here, but not in a meme way. The lesson from past tech giants isn't they disappeared. It's they got normalized. They went from being a toll collector to being a very important vendor. That shift is enough to change the investment outcome, even if the company keeps growing. So what should you actually watch? Stop obsessing over the loud headlines. Watch the boring signals. Watch how often hyperscalers talk about accelerator mix. When that language becomes normal, it means they have choices. Choices create leverage. Leverage pressures pricing. Watch whether the conversation shifts from "we can't get enough GPUs" to "we're optimizing spend." Watch power, cooling, efficiency, and total cost per inference. That's the environment where specialized chips win. Watch internal silicon language. When it moves from pilot to core capacity, that's not PR. That's strategy. I'm not telling you to sell everything. I'm not telling you the party ends tomorrow. I'm not calling NVIDIA a scam. I'm saying don't treat a tech stock like a religion. AI demand is real. NVIDIA is a real leader. The question is how much of the economic value they get to keep once their biggest customers finish building credible escape routes. If you're going to hold for a long time, hold with your eyes open. And don't let the chart do your thinking for you.